Jerz. I want to start with something that sounds impossible. Can a U.S. person, or someone with a real W-2 job, real business income, real tax obligations, legally reduce their federal income tax to zero using real estate?
Yes.
Explain, please.
Most CPAs know this rule exists. Most of them never bring it up. Not because they are hiding it, but because the requirements are specific enough that most clients do not qualify without intentional planning. It is called Qualified Real Estate Professional Status, and it is written directly into the Internal Revenue Code, Section 469. The IRS created it. It is not a gray area. It is not aggressive. It is the law.
What is the rule?
The default rule in the tax code is that real estate losses are passive losses, and passive losses can only offset passive income. So if you own rental properties and they generate paper losses through depreciation, which they almost always do, those losses are trapped. You cannot use them to offset your W-2 income or your business income. They just sit there, carrying forward, doing nothing, unless you qualify as a real estate professional.
And then what happens?
Then those losses become active. They can offset any income. W-2, business profit, capital gains, any income. And because real estate, especially with cost segregation, can generate massive paper losses in the early years of ownership, a qualified real estate professional who is structured correctly can reduce their taxable income dramatically, sometimes to zero.
What does it take to actually qualify?
2 tests. First, you must spend more than 750 hours per year on real estate activities. Second, real estate must represent more than 50% of your total working hours for the year. So if you work 2,000 hours total, more than 1,000 of those need to be in real estate. And you need to document this. Time logs, activity records. The IRS audits this status specifically.
What counts as real estate activity?
Development, acquisition, rental operations, management, leasing, brokerage, construction, renovation, a broad range of activities. And you can aggregate your properties, treat all of them as a single activity, which makes reaching the threshold much more achievable if you have a portfolio.
What about someone who has a business or a W-2? Can they still qualify?
If the W-2 is their primary occupation, it is very hard to pass the 50% test. But for entrepreneurs, consultants, business owners who have control over their time, especially those who are building a real estate portfolio alongside their business, this is absolutely achievable with the right planning. Spouses can also qualify on behalf of the household. One spouse qualifies as a real estate professional. The other has the W-2 or business income.
You mentioned depreciation. Let's go deeper on that. How does cost segregation fit into this?
Standard depreciation on residential real estate is 27.5 years. So a property worth $300,000 generates about $10,000 in depreciation per year. Useful, but not transformative. Cost segregation is a study done by an engineer that reclassifies components of the property into shorter depreciation schedules: 5-year property, 7-year, 15-year. When you combine cost segregation with bonus depreciation, which still exists in modified form in 2026, you can front-load enormous deductions into year 1. On a $1 million property, a cost segregation study can generate over $200,000 in year 1 deductions. For a qualified real estate professional, that deduction is active. It offsets your W-2. It offsets your business income. It eliminates your tax bill.
This is legal.
100% legal. The IRS created bonus depreciation to incentivize investment in real property. Cost segregation studies are done by licensed engineers and reviewed by CPAs. This is not a scheme. This is using the tax code exactly as it was designed to be used, by people who know it exists.
If you are a business owner, an entrepreneur, someone with significant income who is also building a real estate portfolio or thinking about it, this conversation is the one you need to have before your next tax year closes.
Link in the description to set up your consultation and subscribe to our channel. We will see you in the next one.